Hello, Oracles. Well, we've got the Fed that is set to be cutting rates in the next few weeks at the next FOMC meeting. So, a lot of investors are out there looking at, well, where can we put our money that is going to grow and do us the best in the future? Well, you look to growth stocks. We've obviously been having an awesome bull run this entire year as we've been going on. So, are those going to continue going forward? Or are we going to see something similar to what we saw August 5th, a little bit of a scare and a big pullback in the market when it comes to growth stocks? And maybe there's another place to put your money. We just had Nvidia earnings come out. They beat on all levels, but at the time of this recording, the stock has sold off 6%. So, what is going on? If Nvidia, one of the largest companies out there, one of the most anticipated earnings of the season, did well, why are they selling off? Now, there is a support line at the 116 level. So, for any of you interested in that, maybe some swing trading, pay attention to that level right there. See what happens when we settle tomorrow. Maybe we kind of level off. Now, none of this is financial advice, but historically, what I have seen is when you have a company that beats earnings and does well and sells off afterwards, that's typically a good time to buy. And at least in the short term for swing trading purposes, you can make some money off of that. Again, I can be entirely wrong on that, but historically speaking, from what I have seen, that has been the truth, and I have done well with it myself. In my case, I'm going to be holding off on that. My cost basis on it is $123 right now. So if it's going to sell off more, I'll buy more. But for me, it's a very long-term play. So I'm really not too concerned about buying it for a couple dollars cheaper than I have it right now. But when you're looking forward for something longer term, or even maybe just over the next year at, well, what is going to do well? What stocks or ETFs can I put my money into that are going to do well over that next year? Well, when you take a step back and you look at what's going on with the macro environment, you can recognize that dividend stocks, especially those that are high yielding, could be doing very well and be poised to explode over the next few months. Here are the reasons why. Right now, with Jerome Powell coming out and telling us that we're going to be seeing interest rates getting cut at the next FOMC meeting, we are going to see interest rates across the board start to come down. I already got notification this morning from SOFI that my high interest savings account is going from 4.6% down to 4.5%. Doesn't seem like a lot, but we haven't even gotten to the rate cut yet. That trend is just going to continue going forward because chances are once the Fed starts cutting rates, they're going to continue cutting rates, which means that the interest rates for high yield savings accounts are going to come down. A lot of conservative investors have been parking their money in either high yield savings accounts or treasury bonds. All of those yields are starting to come down. They're going to start to look to places to put their money to get a higher yield. Well, high yield dividend stocks tend to be those places. You start to look at safe havens that people go into when we get into recessions, and that's typically where people will put their money. So while I think that we are going to be getting a recession, even if we don't get one, when you start to see those really safe places like high yield savings accounts and treasuries to put your money start to lose their yield, people are going to start to look to other safe havens to put them in. And again, that comes down to those utility stocks that people get into, Duke Energy, places like that, or even those consumer staples like Warren Buffett has, like Coca-Cola, like Procter & Gamble. Even a Walmart is a good place to go. Even if retail does get hit, Walmart's a typically safer place to put your money. These are the places that conservative investors are going to be putting their money as these yields are starting to come down on the high yield savings accounts and those treasuries. Now we also have the election coming up. Historically, you get very volatile times during the election time. That means that higher growth stocks are going to get hit even harder. So a safer place to put your money would be those consumer staple places to put your stocks and other high yield dividends. Now, in a minute, I'm going to go into a lot of the different categories of the dividends that could be doing well. And now once you get past the election, if we do get into a recession, which may end up hitting in early 2025, this is the place that people are going to want to have their money. Again, you go back to the great financial crisis in 2008, this is where a lot of people park their money. Now, again, you're not going to have those dividend stocks going up in most cases. You'll get that explosion coming over the next few months in anticipation of that. But the reason you're going to get that run up into that recessionary time is because that's where people want to have it during the recession, because the loss that they're going to get from those dividend stocks is not going to be as much as a higher growth stock. Plus, they're going to get the dividend coming in that's going to offset any loss that they get in the price of the stock. Now, don't forget, you don't realize those gains unless you actually sell. So dividend investors going through these times have that cash on the side And by having that cash flow coming in from those dividends gives them more cash to be able to buy at lower prices. Because don't forget, the number one way to win the stock market is to buy low and sell high. Or in dividend investor cases, you're going to buy low and you're basically buying income at a discount. Because in most cases, most of these companies are not going to be cutting their dividend. In many cases, going back to the great financial crisis, they still increased their dividends. So now you're buying even more income for even less money. That is a massive discount. That is getting a much higher return on your investment that's going to continue to pay off over the long term. This is why people go into these dividend plays. So now to give you some examples, for instance, Coca-Cola here. Even looking at it at the beginning of the year, it has been climbing up significantly, and we're now up over $20 since the beginning of October of last year. So again, people have been anticipating and buying this up on the way in. And again, you look at a Procter & Gamble, same thing, hit a low of about 138 back in October of last year, and now we're up around the $170 mark. Again, just continually growing, and we could possibly see this go higher. Now again, I do play the gaps, so maybe this one here does come down and fill this gap, and if it does, I would be a big buyer at these levels here. But again, you still see this purchasing over the course of the year, anticipating what could potentially happen as we go into maybe a recession. And another big sector to go into are REITs, that's real estate investment trusts. They typically pay out very high dividends, and they do get some stock appreciation out of it. Not a ton, but you're going to get a high yield. For instance, Realty Income here gets 5.09% on a yield right now. So again, this has been growing. I was buying in all the way back here. I was buying in around the $53 level, and that's where I have my cost basis. So I'm already up $9 on this, and I'm getting that yield as well. Now again, if we get into a recession, this stock price is most likely going to come down, but they did not cut their dividend going through the great financial crisis, even though real estate got hit harder than everything else. They actually increased their dividend going through the great financial crisis. And now another sector to look into is oil. Now oil can be very volatile, but looking at ExxonMobil here, it's been relatively flat over the last year. Go back about a year and the stock price really hasn't moved anywhere. However, you have all these tensions going on in the Middle East right now. Oil plays do pay out a decent dividend, 3.26%. If we end up getting higher tensions in the Middle East, you're most likely going to see oil prices go up. Oil prices have been suppressed for quite a while now, and they've been coming down. So if oil prices spike, you're going to see oil companies' stock prices go up, and they're going to be paying this yield. And if we end up getting that happening, that is almost guaranteed that we are going to go into a recession. Because historically, when oil prices spike, that leads us into a recession. So just something to pay attention to. I currently own ExxonMobil and I own Occidental Petroleum. So those two I have. I'm a huge Tesla bull and I believe in EVs and I think that's going to be the long way of the future, but I'm also taking a look at my portfolio and the best things I can do for my own investments. And I think this is a good hedge on the other side of things because it's going to be a long time before we completely get ourselves away from oil dependence when it comes to vehicles. So to me, this is still a strong play in the meantime until we get further on down the road. And then you've got some very high income ETFs that are out there. For instance, SVOL. SVOL pays out a 16% yield. This is a short on VIX futures. The VIX shows the volatility and the future volatility. Now, they did take a major hit in the price itself when it came to August 5th because we had a massive spike in the VIX, but it recovered very quickly, came right back up. They have been paying this out. And this is not an ETF, despite the fact that we see it growing in price over the last year. This is not something you're going to be looking at getting any sort of price appreciation out of. You're strictly in this for the dividend income. So again, going into a potential recession or some uncertain times over the next few months, getting yourself a yield when we most likely will see the stock market pulling back significantly is going to be beneficial because you'll get a much nicer return and you'll have some income coming in to be able to take advantage of some opportunities. And now another favorite out there for dividend income is JEPI, J-E-P-I. This is the JP Morgan Equity Premium Income ETF. This is another ETF that plays call options on the S&P 500. So they're playing based off the S&P 500. And again, the more volatile the market gets, the higher those premiums are going to be coming from all of the options trading. So very good potential return for dividend income. Now, in future videos, I will dive into some of these stocks and ETFs a little bit deeper to let you guys know what they're all about. And again, I'm all about you guys doing your own due diligence and research. So on my end, I'm just going to introduce you to them and why I like them and what they're doing for me, what they're paying out, little things like that, so that you guys can say, hey, that's something that I think would be good in my portfolio. Let me dive into it deeper. So I'm going to be sharing with you guys some of those stocks and ETFs that I'm in, just to kind of let you know what I've been doing with my portfolio and how I am preparing for things coming up when it comes to the election time, potential recessions, and just for a normal portfolio going over the long term, and how I plan on getting myself to early retirement. So hopefully you found this video helpful today. If you did, please hit that like button down below, subscribe to the channel. I appreciate all the support. Have a great one.